This is Nightly Business Report with Bill Griffith and Sue Herrera.
Growth spurt. The economy expands by a lot more than expected in the first quarter, sending the S&P 500 and the Nasdaq to new highs. Oil slick. Prices have been rising, so why are profits at Exxon Mobil and Chevron falling? Cut in half. Amazon is spending big money to get packages to your door in one day, ramping up the pressure on its rivals. Those stories and more tonight on Nightly Business Report for Friday, April 26th. Good evening, everyone. I'm Kelly Evans, in tonight for Sue and Bill. The S&P and Nasdaq finished the week at all-time highs, thanks in part to the economy, which is powering ahead. Today, we learned that activity in the first quarter was a lot stronger than expected, shaking off a rocky finish to 2018. The first read on gross domestic product grew at an annual rate of 3.2%, well above projections of 2.5%. In fact, it's the best start to a year since 2015. As you know, gross domestic product is the value of all goods and services produced in the U.S. Rising exports, falling imports, and higher inventory investment drove much of the growth. That helped offset weaker gains in consumer spending and business investment. And that report gave the major averages a lift. The Dow Jones Industrial Average was up 81 points, the Nasdaq added 27, and the S&P 500 gained 13. But it wasn't just the economy that investors were watching. Bob Pisani starts us off tonight.
Stock futures spiked early on a much stronger than expected read on first quarter GDP growth in the U.S. But disappointing results from Exxon and Intel weighed heavily on the Dow. Shares of Exxon, for example, slumped about 3%, had their worst day of the year after profits took a hit from poor refining, that's gasoline refining mostly, and chemical results. And the oil giant said that while crude oil prices have risen, they're still relatively low compared to prior periods. We're also seeing some signs of the China slowdown story really starting to take a toll on the earnings equation. So look at today. Intel slashed its full-year revenue outlook, largely blaming slower growth in China, saying customers were becoming more cautious and that they were seeing an acute deceleration, that's their words, in demand for chips in that region. Now, this follows similar comments made by other chip makers like Lam Research and Texas Instruments. But others have been more positive. For example, Ford CFO Bob Shanks said the Chinese economy seems to be stabilizing. And the luxury goods manufacturer Hermes said sales in China were actually accelerating. The bottom line is this. The U.S. economy continues to outperform, but global growth is still a problem. It's not clear if China is accelerating or decelerating, despite massive stimulus from its central bank. For Nightly Business Report, I'm Bob Pisani at the New York Stock Exchange.
Let's turn now to Jim O'Sullivan to talk more about the GDP data and what it is really telling us about the U.S. economy. He's chief U.S. economist at High Frequency Economics. Jim, welcome. Good to see you.
Thanks, Kelly. Hello.
So there's the components of the report which show consumer spending was okay, business investment a little bit weaker. Are you with those who say the one-time contribution from exports and inventories will be reversed next quarter?
Well, I mean, there's always volatility in the details from quarter to quarter, so you can always quibble a little bit with it. But I think it is fair to say that the inventory number probably will go negative over the next quarter or two. So that part in particular probably will be reversed to some extent, and that boosted the number. On the other side, the consumer spending number of 1.2% in the first quarter was probably artificially weak. And we saw during the first quarter momentum pick up as the first quarter ended. The March retail sales report was very strong. So chances are consumer spending will be a lot stronger in Q2. But I think the net of it is that, yeah, growth probably is moderating a bit. The trend probably isn't 3%, but there's no sign of any major slowdown, I would say.
And Jim, that's a big deal because the market sold off concerned about a U.S. slowdown, especially at the end of last year. Now with this strong first quarter number, even with the government shutdown happening at the time, is that why stocks are at highs? And is that why people think there might be some sustainability behind something north of 2.5% for the U.S. economy?
Well, it's two things, really. On the one side, the growth numbers are good enough and strong enough to tell us that worries about dramatic slowing were overdone. On the other side, the inflation numbers have been very tame. A big part of this morning's report as well, of course, was the core PCE price index that the Fed zeroes in on, and their goal over time is 2% for that inflation number. And that number on a quarter-over-quarter basis was just 1.3% this morning. And of course, we've heard pretty dovish commentary from Fed officials over the last couple of months. And with inflation as low as it is, it's pretty clear they're not going to tighten anytime soon. At the same time, with growth as strong as it is and the labor market numbers as strong as they are, and financial markets, as buoyant as they are, they're not going to ease either. But I think from the stock market's perspective, a Fed on hold story is a pretty good one.
Finally, Jim, Bob Bassani mentioned this concern about China. It's still not clear if that country is doing okay. Is the U.S. able to continue growing even if China's weaker and Europe, as we know, is weaker?
Well, I mean, even if China goes from what they report as 6.5% down to 6% or back up a little bit, it's not going to dramatically change, I would say, U.S. growth. I mean, certainly to the extent there are changes in China and that filters into global financial markets, I think that's a different story. But certainly at this point, global financial markets are pretty buoyant. Obviously, we just hit a new record on the S&P 500. So I don't think from that perspective directly China's that important. And plus, at the same time, the latest numbers out of China, for the most part, have actually been a little bit better.
Jim, good stuff. Thank you for your thoughts.
Thank you.
Jim O'Sullivan is with High Frequency Economics. Oil prices, meantime, came under pressure today after President Trump said he told OPEC members to lower prices. Domestic crude settled down about 3%, and that snapped the commodity's longest weekly win streak since the first half of 2015. Despite today's decline, oil is still having a big run-up this year. It still gained more than 35%. Given that, you might assume that the country's two largest oil producers would be doing well. But that wasn't the case when Exxon Mobil and Chevron reported earnings. Both saw profits fall in the most recent quarter, and that sent their shares lower during today's trading session. Dominic Chu takes a closer look.
One of the biggest drags on the Dow today is Exxon Mobil, after the integrated oil and gas giant, America's most valuable energy company, posted profits and sales that both fell below average analyst estimates. Now, a big part of the story at Exxon Mobil focused on the downstream or refining and chemical operations. It said profit margins were also weaker due to, among other things, higher refinery maintenance costs. Now, a bright spot for Exxon Mobil remains on the production side. Overall production of oil and gas rose by 2% over the same time last year, meaning it now pumps out 4 million barrels per day. And when it comes to U.S. shale production at the all-important Permian Basin, that's 140% higher than it was last year. A similar story with fellow energy company Chevron. The fellow Dow component was also a drag on the overall index after it beat analyst profit estimates but fell shy on revenues. It, too, grappled with falling profits at downstream businesses like refining and chemicals. But it also saw overall production rise, like Exxon Mobil, helped along by U.S. shale oil and gas production. For Chevron, though, investors are perhaps more focused on its pending bid for smaller competitor Anadarko Petroleum. That deal was upset after Occidental Petroleum came in with its own bid for Anadarko that trumped Chevron's. A key story for oil and gas in the coming months will be the trend of oil prices, as well as the possible merger activity as bigger players look for more U.S. acreage in shale assets. For Nightly Business Report, I'm Dominic Chu.
Now, trade negotiators from the U.S. and China are expected to meet next week. Today, the president of China sent a message to the U.S., and he did it in front of world leaders who are gathered at an infrastructure event in Beijing. That, as we reported last night, has been the target of widespread criticism. Eunice Yoon is there.
President Xi Jinping defended his Belt and Road Initiative and addressed concerns about the massive infrastructure program. Here at the Belt and Road Forum earlier today, President Xi made a keynote speech countering criticism that the program is a debt trap, unfairly favors Chinese companies, and generally needs to be more open. President Xi said China would ensure the financial stability of the projects, have zero tolerance for corruption, and choose projects in a transparent way. But President Xi pushed back on the worries stoked largely by Washington with a veiled shot at the U.S. He said, "We hope other countries will also create an environment that enables investment, treats Chinese enterprises, students, and scholars as equals, and provides a fair and friendly environment." Washington and Beijing have been blocking visas for people, the latest weapon in their rivalry. His remarks show that despite all the talk of inclusiveness here, that China's leadership still isn't fully aware of its contributions to the frustrations of its trading partners like the United States, and that more conflict is likely, whatever happens with a trade deal. For Nightly Business Report, I'm Eunice Yoon in Beijing.
Here in the U.S., consumer sentiment remains near historic highs, despite softening slightly in April. According to the University of Michigan Sentiment Index, roughly 44% of respondents said they expect their financial prospects to improve this year. That's the best reading since 2004. Economists say the report could signal that consumer spending is poised to pick up because high levels of sentiment, in theory, translate into higher levels of spending. Amazon is one beneficiary from all of that spending. Today, the e-commerce company said it is speeding up delivery for Prime members. It's making a big investment to make one-day shipping the standard, and it may have caught rivals like Target and Walmart off guard. Courtney Reagan has the details.
As Amazon works to cut its U.S. Prime delivery time in half from 2 days to 1 day, competing retailers have decisions to make. How much are they willing to spend to keep up with Amazon? Target and Walmart both offer 2-day shipping online for millions of items as long as you spend $35 and without a membership fee. Amazon's annual Prime cost is $119.
Roughly 90% of the retail market is still offline, roughly 10% online. Amazon has about a third of that market. I think clearly they're making the bet that over the next foreseeable future, with moving to one-day shipping, you can gain significantly more share from that offline market.
In response to Amazon's new shipping goal, Target says it offers, quote, numerous ways to shop same day and receive purchases within hours. At many stores, Target shoppers can pick up online orders in store with Drive Up or Order Pickup. Target's Shipped service is same day, but there is a $99 annual fee for that. Walmart also has online order pickup options, but declined to comment in reaction to the Amazon news.
The buy online pickup in store model is still incredibly effective for the brick and mortar guys. And for Amazon to keep pace without making a big expansion into brick and mortar, they're going to need to go faster.
Most retail experts agree the most ideal scenario is to have both a strong store strategy and efficient online operations. Traditional store retailers like Walmart and Target have spent billions to build and improve digital operations and speed up shipping, while Amazon has been building its physical store fleet.
I think they woke up to that reality around 2 years ago when they acquired Whole Foods. Having a dual online-offline strategy is the right one, but I don't think Amazon is necessarily kind of losing that battle. I think that process is progressing relatively slowly, and I think Amazon has the wherewithal, they have the smarts, they have the data to kind of have a big seat at that table.
Walmart and Target will have to decide whether to try to keep pace with Amazon's one-day shipping goal and evaluate what that might cost. Amazon's spending $800 million towards its goal in just the second quarter. And Walmart has already said its digital operations will post a bigger loss this year than last.
This is something that over time will only differentiate the Amazon value proposition, will only make Amazon stronger, and frankly, not great news for e-tailers, not great news for retailers.
The big question remains, can Amazon do it? As more Prime members have joined, there are some customers that say shipping has slowed and isn't always 2 days, but longer. But if Amazon does succeed with one-day Prime shipping, the bar and the cost just got even higher for competitors. For Nightly Business Report, I'm Courtney Reagan.
And it's time to take a look at some of today's upgrades and downgrades. Starbucks was downgraded to market perform from outperform at Wells Fargo. The analyst says the shares are fully valued. Despite the coffee chain's plan to expand in China, their price target is $80. Despite the downgrade, shares rose a fraction today to $77.45. Illinois Toolworks was upgraded to neutral from underweight at J.P. Morgan. The analyst there cites improving fundamentals at the global manufacturer. Their price target is $144, and today's shares closed at $153.59, up about 1.5%. Shutterfly was also upgraded to outperform from market perform at Raymond James. That analyst citing growth around Shutterfly's core business. Their price target is $56. The stock rose nearly 4% today to $43.85. And still ahead, don't bet against the American consumer. Our market monitor has names she's investing in for the long haul. Now, American Airlines cut its profit forecast, and that's where we begin tonight's market focus. The carrier is facing higher fuel costs and taking a $350 million hit due to the grounding of Boeing's 737 MAX planes during the busy summer travel season. But on a conference call with analysts, the CEO said he expects the jets to be flying again by mid-August.
We came to the conclusion that we needed for our customers certainty in booking and for our team members to put the startup date as far out in the future as we thought. As we said to the FAA and Boeing, look, we need like 95% certainty that the aircraft, that what we're going to be selling will actually be flown. That's what we think about August 19th.
American Air fell 1% to 33.06 today. AutoNation posted mixed first quarter results. The nation's largest automotive retailer topped earnings expectations, but revenue missed. The CEO says the company sold fewer vehicles at a higher profit to counter the weaker sales. Today, the stock surged 7% to $42.31. And strong North American sales, particularly of toothpaste, helped Colgate-Palmolive post better than expected earnings. But the consumer products giant did see a slump in Latin American and European sales. Colgate also confirmed its full-year sales guidance. The stock rose just about 4% today to $71.30. And the Justice Department has opened a criminal investigation into Ford's emissions certification process. In February, Ford said it began an internal investigation into its vehicle's fuel economy and testing procedures. This comes a day after Ford reported strong earnings. The shares jumped more than 10% to close at $10.41. And it's time now for our weekly market monitor, who likes consumer names she says will do well in an up or down market. This is her first time on the program. In fact, she's Sarah Henry, portfolio manager at Logan Capital Management. Sarah, welcome.
Thank you.
You have a number of picks here, some very familiar names to everybody. Let's begin with Pepsi.
So Pepsi, when you think about what constitutes a really great staple stock, Pepsi has all the attributes. They have global reach, big brands, they throw off a ton of cash flow, they're important to retailers, high frequency turn. So we really think this stock will be a source of enduring earnings growth over the next few years.
Okay, and how about Unilever?
So Unilever, it's a little bit of the same song, different notes. It's a global multinational HPC, personal care, food, refreshment, names like Ben & Jerry's and Dove, and the preponderance of their revenue comes from the emerging markets. And so those markets are growing much faster than developed markets, and it contributes to organic growth above expectations much of the time.
Sarah, we heard from other companies like Colgate-Palmolive that international exposure is actually a source of weakness. Are you concerned with Unilever that strength might turn into a liability?
It's reasonable to, be careful about the emerging markets because they can be volatile at times, but we did not see that from the quarter that Unilever just reported. We saw strength. We saw consumers in those regions reaching for higher priced items, which is leading to higher margins. So that company has done a really good job at bringing to market the things that consumers want.
All right. And finally, McDonald's. What's the story there?
So McDonald's is going to report next week, and they have really engineered a whole-scale financial and entire renovation of their store base. They are rolling out these Experience of the Future stores, which has caused them to raise CapEx spending a little bit, but they have been another reliable organic grower. The thing that's interesting with McDonald's is that it is a royalty story. So it has a tendency to be less volatile than other stocks. We often call it a mixed staples company because even though it resides in the consumer discretionary realm, it is a very stable source of earnings and one that's likely to grow again for the next foreseeable future.
All right, Sarah Henry with some good, solid picks in the consumer sector. She says they'll do well in an up or down market. Thanks for joining me. Sarah Henry with Logan Capital Management. Coming up, the Silicon Valley startup that's offering a new hope for canines with cancer. Here's a look at what to watch next week. Earnings continue to roll in. On Tuesday, we'll hear from Dow Components, McDonald's, Merck, and Pfizer. On Wednesday, the Federal Reserve will announce its decision on interest rates and give investors more insight into what it might do next. And on Friday, the government releases its monthly employment report, and that's what to watch next week. Uber set a price range of $44 to $50 per share for its initial public offering. That would give the ride-hailing company a market cap somewhere between $80 and $90 billion. They are looking to raise about $9 billion in cash. In the filing, Uber said it lost about $1 billion in the first quarter. Reports say it could begin trading on the New York Stock Exchange in early May. And it's no secret that people spend a lot of money on their pets. That's especially true when they're sick. Companies like Merck and Zoetis play a big role in the fast-growing pet health market. But now a Silicon Valley startup is developing a cutting-edge treatment using precision medicine to treat dogs with cancer. Frank Holland has more.
Lulu lost a leg to cancer, but not her spirit.
There's just so much about her that is resilient. When things are down, she just goes right on.
The 11-year-old Maltipoo was limping 6 months ago when Kathy Guptill came home. Lulu has knee problems, so it wasn't a surprise, but the diagnosis was a shock.
He called like the next day and said she has a tumor there, and it's probably a sarcoma.
It was myxosarcoma, a cancer that is aggressive, has high potential to spread, and is more likely to recur. 1 in 3 dogs will get some form of cancer during their lifetime. Lulu's family tried something cutting edge. It's called PhytoCure from Silicon Valley startup One Health. PhytoCure uses gene mapping to create targeted treatments using human cancer drugs.
We do the genomic testing. What that means is a characterization of that tumor, so we understand what's driving that dog's cancer. We come from the principle, the scientific principle, that every cancer is unique.
Dr. Christina Lopez is co-founder and CEO of One Health. She says PhytoCure is less expensive than chemotherapy, which can cost as much as $10,000.
Morning.
Overall, the pet cancer therapeutics market is growing by more than 10% per year and is expected to reach $300 million by 2024.
Hi, sweet girl.
Lulu's vet says she used different chemotherapy and drugs than she would have normally because of PhytoCure.
I'm now able to come to my clients and say, your dog's tumor, these are the drugs that are going to be effective, and then here's the way I would start doing this.
One Health provided data on a small sample of 38 dogs that did not respond to other treatments and were considered terminal before they were given drugs by a vet using PhytoCure. Patients in this group were given treatments ranging from 13 months ago to as recently as 2 months ago. As of now, almost 2/3 of those dogs are still alive.
Good job, that was perfect.
Lulu is in remission now, a relief for her family.
She takes the licking and keeps on ticking.
For Nightly Business Report, I'm Frank Holland.
And before we go, let's take a final look at the day on Wall Street. The Dow was up 81 points. The Nasdaq added 27, and the S&P 500 gained 13. And it was a mixed finish for the week, with the Dow slightly lower, the Nasdaq and S&P higher. And that's Nightly Business Report for tonight. I'm Kelly Evans. Thanks for watching, and have a great weekend, everyone. We'll see you Monday.